So, then thank you for taking time being with us today. Tell us a little bit more regarding your background and how did you get into real estate?
Yes, absolutely. Well, again, thank you for having me on the show. I really appreciate it.
Sure.
Love what you're doing, love the content you're putting out there, and it's just a pleasure to be on. So, my background, I started off going to college in southern Utah, and while I was going to college, I took all the fun classes year one. And ended up doing outdoor rec and scuba diving and a couple little business classes. Well, year two came around. They told me to get serious. I had to take, some harder classes. And I said, well, I don't know how exciting that sounds. So I went off and I bought, I did a coaching program for real estate instead, which was with Robert Kiyosaki. And it was a 1-year course. And during that 1-year course, I was able to acquire 4 properties. I got a single family home. I bought a duplex, a fourplex, and a sixplex. So I just scaled very quickly in a year. But these were all highly value-add deals in my backyard. So during that time, at the end of the year, I looked back and I said, first of all, I love real estate. This has been great. And love creating the value, love turning these projects around, stabilizing them. But at the end of the day, I looked and saw what kind of equity I had in those deals. And I was pretty blown away because what I was going to go to college for couldn't even touch or get near to what I was, creating in value and wealth in these deals. So over the next 3 years, we quickly scaled up from fourplexes in Utah and Las Vegas. We got to about 50 units, and then we started buying some bigger complexes. So I bought a 48-unit apartment building, and then a 138 unit. We had about 250 units in our portfolio at that time. And really, it was great to kind of learn the lessons and go through the multifamily experience from smaller complexes to the larger ones. But at the end of the day, I was getting burnt out. These were Class C properties. They were management intensive, and we had created a lot of equity in them, but it was just a lot of everyday work that everyone tells you get into real estate and it's very passive. Well, that was not the case with this portfolio. It was very active, and so we ended up selling those 250 units over the last couple of years. And I transitioned and really started focusing on true commercial properties. So to date, we've bought about a dozen commercial properties between retail shopping centers, medical office buildings, and industrial complexes. And so now a buddy of mine likes to call it the evolution of a real estate investor. And so we were able to go into these different asset classes. And I got to tell you, I love commercial. It truly is my passion. I'm able to create a lot of value very quickly, and very, very much more less management intensive than the residential and multifamily world. So that's where I am today. That's where I'm focusing, and just building up our portfolio in the commercial.
I got a couple of questions. Can you run us through the first deal? If you were in college, how did you get the capital, and how much was what was the price point of the first property that you bought?
So it was actually a 6-unit apartment complex that I bought. It was fully vacant. It was bank owned, and it was my local banker that took the deal back. And so we already had a connection with them. I had done, what my coaches had said, hey, reach out to bankers, see what they've got in their portfolio that's not performing. So what I did was I went to them and I said, look, I want to buy this from you. And they said, well, okay, but you don't have the backing. So I went to a family member and a local hard money lender in town. So my family member co-signed on the loan with me. And then the hard money lender lent me the down payment and the capital improvement funds that I needed to turn the property around. So I bought it for $155,000. I put about $30,000 into the property, and then I was able to sell. I ultimately sold the property for $330,000. But what I did before that is I refinanced and paid off my hard money lender and then had some capital left over that came to me, and this was all done in under 6 months, where I bought it, fixed it up, filled it up, and refinanced.
Gotcha. I have a couple of questions because I like Charlie Munger, Buffett's partner, because he sees everything from the other way around. He always asks himself, how can I get screwed? And on that line of thought, I would like you to kind of walk us through the first deal. And I got some questions here for you. I'm going to read them. Would you sign a purchase agreement before having investors? Yes or no?
Yes.
Why?
Because I need to lock up the deal and make sure it's a good deal. And then if it is a good deal, then I go to my investors.
But you will lose the escrow money if you don't get investors, right?
No, because you have a due diligence period. So normally I would ask for 30 to 60 days of due diligence, and during that due diligence time frame, I can send in a termination clause terminating the contract and getting my full earnest money deposit back sent to me. So the only thing I lose is the time and and my attorney's cost for preparing the purchase and sale contract.
So, in following that line of thought, what must be in the purchase and sales agreement playing as a defense for you not to get screwed?
So one thing I do is in every purchase and sale agreement, I always put a clause in there stating that if I decide to terminate the contract during due diligence, I do not need the seller's written sign off to get my EMD back. Because a lot of times sellers might try and hold you up and try and get that money from title. But if you have this clause in your purchase and sale contract, you send that over to the title company and they have to release it based on that's what's in the PSA.
And how do you protect yourself doing the due diligence? And I'll give you an example. I'm super creative, but I'm not very reliable on details because my brain is not oriented like that. I usually surround myself with people that are really super detail oriented. How do you protect yourself for the due diligence?
So I have a good team. One is I have a fantastic attorney that reviews everything from the PSA to the leases to the title to the survey. So we dive into all that stuff together. We go through all our findings. We make sure that we get a phase 1 done. We get which is an environmental test to make sure that we don't have any environmental hazards. We also do a property condition report, which is professionally done as well, and it goes through all the components of the property from the roof to the HVAC to the structural to the plumbing, and then anything that needs to get more detailed, then we'll bring out an expert. So if we have a roof that may need to be replaced in the next 5 years, or they're saying that hey you've got some serious issues up there, you may want to take a look at that. Then we'll send out the professionals. We'll get bids while we're in due diligence, so that way we know going into the deal how much we've got to spend to stabilize our asset, to really bring it up to our the kind of condition that we want to own it in, and that's normally what I would do. So by the time my money is about to go hard, I know how much I plan on spending in the property, and if the deal still makes sense at that time, or if I have to renegotiate, or if I have to terminate the deal.
Gotcha. And at this time, since properties are super expensive, are you underwriting everything like for a period large, let's say for 10 years, because you are expecting a market correction?
So yes, I do believe that a market correction is coming. I absolutely believe that. And the way that we're buying right now is we are bottom feeders. I mean, look, I'm not going to lie. I am looking for dirt cheap deals that are in great locations. I'm looking for REOs. I'm looking for defaulted loans. CMBS defaults are great opportunities right now, and I really see that being the biggest opportunity for commercial real estate over the next 24 months. And that's what we're seeing, is that these 10-year fixed loans that were put in place in 2005, 6, and 7 are now coming up for renewal, where they either have to refinance or sell the property. And in a lot of these cases, a lot of these mortgage loans are still underwater, and so they're giving them back to the bank, and the bank is now they're as I do, they are not commercial. They're not very good at managing commercial property, so they want to get them off their books as fast as possible. And that's where we come in, where we see the opportunity, and we're buying it at a huge discount from them. And then that's where we create our upside, right? We go in there, we fix the problem, we fix it up, we fill it up, and then we've got our nice equity stake in the deal.
But at this time, because I've been getting a lot of deals and we are agreement, I think the market is up for a correction. But names like the big brokers, you know who they are, and you're kind of always dependent on the deals that they have. Do you have other ways of getting deals besides the usual suspects like brokers and property managers and so on?
Absolutely. I mean, look, you have to rely on brokers to bring you deals, but definitely that can't be your only deal funnel. I mean, you have to create different avenues to, get the deal flow coming in depending on market conditions. I mean, like right now, market's really hot, so it's hard to find a value add deal with a broker because a lot of times they want to sell it to you based on pro forma price. Well, you and I don't want to pay pro forma price, right? We want to pay on actuals, and we want to pay wholesale and sell it at retail. So what I'm doing is I'm starting to do mailer campaigns where I've landed a couple deals. I just bought a Starbucks last week, which was a mailer campaign deal, never hit the market. I was able to get owner financing for 10 years fixed at 3%. Just incredible terms. And I had 8 years left with Starbucks. But so that was one way. So doing mailer campaigns, going out to RIA clubs, is a great way to network with people that are wholesalers that are finding deals and just want a fee for flipping them to you. There's other ways as like CoStar, for instance. You can get on, and if there's certain properties that you are interested in or certain areas, you can pull up all the owner's information, and it usually has their email address and their phone number, and you can call them direct. So that's another way to find these opportunities in this marketplace.
And I'm glad that you brought Starbucks up, because this is one of the questions that I had here. Companies like Starbucks and McDonald's and Dollar Sign and Costco, all those types of companies, do you think these are always good deals because these are solid companies and they will cash flow for years?
Well, not necessarily. There's plenty of national companies that are going out of business all the time, but just as much as that are going out of business, there are plenty that are replenishing these vacancies. And, this is people are kind of scared a little bit about retail right now. And for me, it's more opportunity, because the way that we're underwriting this is looking at, the market overall. And what it's saying is that, look, even though you've got lots of retailers that are going out of business, like Payless Shoes and Sports Authority, and these type of businesses that necessarily aren't performing so well, and so they're claiming bankruptcy. Well, there is probably 5 to 10 times more companies that are starting up and that are expanding. Subway is looking to open 1,000 new locations in the next 24 months. And Starbucks, they're opening new locations, couple 100,000 over the past few years, which is just incredible growth. And so when we look at these deals, we say, okay, yeah, let's look at the tenant, let's look at their credibility, let's look at are they public, are they private, and what is the likelihood that they're going to be around in 5 or 10 years when their lease comes up. And so like with Starbucks, you can't order your Starbucks online, right? You can't order these type of things like a haircut online, right? So you got to really be able to look at the whole dynamics of the market to really determine if you really feel like this tenant is going to be there long term from now. I'm a little bit worried about like car companies like AutoZone and O'Reilly's Auto Parts, because a lot of those things you can get online now at a better price. And so, the likelihood that those will be around in 10 years, I don't know. But all I do know is they have great locations. So maybe, if you buy it based on a land play with in-place cash flow now, what the dynamics are long-term and short-term.
At this time, at least here in Portugal, shopping malls, there are not so many, and they are quite in demand, meaning people always go there. And to be honest, I'm pretty comfortable having people, if I were to buy a shopping mall here in Portugal, having customers at least for the next 5 or 10 years, because it's a consumer thing. It's staples. People go there to eat and coffee and so on. What I'd like to know is, do you like shopping malls in the US, or do you see there's a different trend in what's happening here in Portugal?
Okay, well, I couldn't really tell you because I just don't follow international markets. I'm really only focused on in the U.S. and primarily in the Northwest, Southwest, and the Rocky Mountain region is where my primary focus on acquisitions is. But what I can tell you is that these markets are strong. A lot of people are moving their money internationally in foreign investment dollars into the U.S. because the market is it's got great returns. We've got a great economy. Obviously, we have our downside, and there's lots of issues going on internally. But that's anywhere. I mean, so but looking at it from a global perspective, I mean, we are the powerhouse of the nations, and so a lot of people are moving their investment dollars this way, and so do I see that helping the investments that I'm going after? Absolutely. I mean, a lot of times these properties that we're selling, a foreign buyer comes in and is buying these properties, and they're looking at it from a long-term hold, not necessarily the way that I underwrite every deal. Some of my deals are very short-term and versus some are long-term type of investment. So every deal is a little bit different in that perspective.
But in the US, coming back to the question, do you see a shopping mall as a good asset to acquire?
Yeah, absolutely. Yep. I'm very bullish on retail.
And regarding your underwriting, what do you like to see? Let's say both of us have a deal across the table. What do you like to see regarding cash on cash, debt service coverage ratio, average IRR, usual holding period? Run us through the numbers, Annie.
Well, what I like to achieve in a deal is a minimum of a 12 to 15% return on investment for my partners that come into the deal. The way that we're doing these projects is we're raising investment capital from private investors that are looking for a good return on their money. So we're typically looking for a higher cap rate, solid location. Some of the deals are anywhere from a 1 to 2 year hold. Others are 3 to 5 year hold. And then others, we're putting long-term fixed financing such as CMBS 10-year fixed debt. And it's all depending on the deal and what we're looking to accomplish. And so whether that's cash flow, whether that's equity, or looking to get a large return on investment in a very short amount of time on a deal that we fix up, fill up, and flip versus a deal that we make a couple small tweaks to stabilize the rent roll and the asset, knowing that it's such a solid location. We want to be there for the growth over the next 5 to 10 years. So we look at every deal a little bit differently, and that's why we have different pools too, because I have different type of investors that want their money moving quickly, and others want to place it, set it, and forget it, and get a nice cash flow check every single month.
And at this time, since we already covered a little bit regarding Starbucks and multifamily, where are you almost exclusively focusing your attention on acquire multifamily assets, or at this time, since everything is kind of a bit expensive, you're looking for other avenues?
Yeah, I am not buying multifamily right now. I've sold all my multifamily at this point. The market is incredibly hot right now. And it's a great time to sell and take chips off the table. So right now, my main core focus is shopping centers, industrial buildings, and medical buildings. So I'm buying, true commercial assets right now where there's still value to be had. Right now, I just don't see how it's attractive to buy a 100-unit apartment complex built in 1965 at $40,000 a door. In a tertiary market, and the only way to create upside is by fixing up the units and getting an additional $50 rent bump per unit. I've been there, done that, and I can tell you it's a lot easier said than done. You're going to have a lot of issues. I mean, something that old too is just going to have a lot of problems in general. When you can go buy, you're going to be buying this deal at a low or mid high 6 cap range. Because that's what multifamily is going for right now in this area. But you could go buy a Starbucks for a 6.5 cap with 8 years left on the lease, brand new construction, and you've got great financing in place, and you're going to get a call once a year, maybe twice a year, versus a call every other hour on this multifamily asset. And so I just to me, it made a lot more sense going into the commercial world, looking at, every aspect of it from the stability of the cash flow, from the stability of the tenants, from the age of the asset, from the location of the asset. And that's why I primarily focus in this asset class.
Even if you were like starting out and starting to develop relationships with brokers, starting everything from the beginning, these are the types of asset classes that you will be looking for.
Absolutely. I mean, look, you have to be very careful in commercial assets. I mean, you can get hurt pretty badly if you don't know what you're doing, if you don't understand it. You have to understand triple net leases. You have to understand gross and modified leases. You got to understand how valuable a location is and what market rents are for that area. And there's so many things that you really have to dig into in the commercial world. So you have to be more diligent in commercial, but you can make a lot more money with a lot less headache if you know what you're doing.
Gotcha. And regarding for the future, where do you see yourself in the future of your company heading?
We will continue to buy larger assets in the retail shopping center world. We'll also focus on industrial complexes, and really we are building a network of more investors, more people that are looking to partner up and move into the commercial world, because a lot of times people just do not have access to these type of investment opportunities. It's very easy to find, house flippers or, multifamily guys, but you rarely hear of the guys doing commercial. And it's typically the big boys play in this arena. And so, we want to continue building our portfolio and building our investor base as well.
Gotcha. And going back, advice to your younger self, what would you say?
Stay out of Class D war zone properties.
Gotcha. And regarding books, run us through a couple of your favorite books that you like to share with our listeners.
Well, a classic. I mean, look, I read it every year. Is Think and Grow Rich. I just that book. If there was no other book out there, and you only read this one, I think you could become very, very extremely successful just by reading this book and implementing, the principles that they teach you. So that is by far one of my favorite books, and so I recommend that to all your listeners.
And finally, where can our listeners get a hold of you if they have any further questions?
Yeah, look, if they're interested in reaching out, they can go to my website at valueinvestmentgroup.com. That's VALUE investmentgroup.com. And you go there, put in your contact information. It'll get sent to me. I'll reach out to you personally. If you're interested in just talking over your deals, or you're interested in investing in our deals, would love to talk with you more.
Then it was wonderful having you this day. Hope to speak with you soon.
Hey, thank you very much. I really appreciate it. Thanks for having me on.
Bye.